Welcome to the show, everyone. Today we have a very special guest. His name is Benj Gallander. Benj is the president and founder of the Contra the Herd newsletter. Contra the Herd came out all the way back in 1992, and it was in 2015 that I first interviewed Benj, and that interview turned into a chapter, the first chapter for my book, Market Masters. So welcome back, Benj. It's great to see you.
It's a pleasure. And I'll mention that I'm a co-founder because myself and Ben Stadelman founded it together. And I met him way back at the University of Western Ontario in 1979. And we're still business partners today, so we must have done something right because a lot of partnerships don't stay together that long.
Yeah, you've done something right. We were going to do this interview, I think, 2 weeks back, just after Christmas, but then you sent me a rescheduled notice to say, hey, Robin, is it cool we push this out? Reason being is because tax loss selling season. And I think you were just salivating at all the good deals that were coming about at the tail end of 2024. So tell me about why tax loss selling season excites you so much, and what were some of the deals you're scooping up?
Well, it excites me so much because you can get better deals. So we are buying into stocks that are out of favor. And what happens is at the end of the year, a lot of people simply decide to dump their stocks and take the loss. I understand it. We, on the other hand, like to take our tax losses in May or June. Because by doing it at the end of the year, you've got an awful lot of people who are doing it. It increases the supply of the stock incredibly. That knocks down the price. That means you get less money. So when those people are dumping, I'm there with open arms saying, give it to me, give it to me. And Robin, I've been doing the same thing with very slight variation seemingly forever. I mean, we've been doing the investment ladder for a very, very, very long time. Let's call it 30 years. And I sometimes compare it to when people are at school and they have an exam and they know the exam is in a month's time. And when do they study for it? The last couple nights. When do they do the paper? The last day or two before it's due, even if they know a month ahead. And some people thrive under that pressure. I personally don't. With stocks, I know if I wait until the last minute, I would then be going in with all kinds of other people looking to dump, and again, getting less money. So I'm looking to dump when people aren't doing it. So again, the winners I can sell virtually at any time of the year, but I don't generally do it in the last couple of months to defer taxes. But the losers, as I said, I'm generally looking at the spring. I mean, the idea at the end of the day is to get as much money out of this as possible. I hate to sound completely like a capitalist, but there's certain patterns that you can follow to do it. And after doing this for so long, I think I've got a pretty good idea of the patterns that work for us.
And so that pattern, tax loss selling season, when you like scooping up shares, December, that then turns into what we've heard as the January effect. Can you explain what that is in the current month we're in?
Well, the January effect is the beginning of the year. Stocks generally go up. On average, I believe it's about 0.5%. Now, of course, that doesn't mean that it happens every year. Some years stocks go down, some years they go up. But, I'm in kind of a funny position because we're always looking to get huge returns. Every stock I buy virtually, I'm looking at getting 100% return. Often it can take years, but if it takes 10 years, which I hope it won't, that still works out to about 7% a year. It's looking to get huge returns all the time is far different than a lot of people and a lot of companies that are looking at something far smaller and maybe in a shorter period of time. And one thing I never have is a time frame from when I buy a stock to when I might sell it, because I never can know. And when you're looking at potentially having a 300 or 400% return, it can take a long time to do. But as you know, one of the key tenets of the methodology that I use is patience. And patience to buy, patience to hold, patience to sell. And to me, that's absolutely critical. And I've been doing this for so long that, and I'm older now, it's easier, I think, in a lot of ways to be patient. You learn, you mature, so it's not a challenge at all.
So the viewers can really understand your process, Benj. Can you share an example of one of the company shares you're scooping up in December, and your thought process? Can you walk us through?
Well, in fact, this December, I bought the least number of stocks that I think I have ever done, which means I bought one stock. Normally, I would buy 4 to 6, and the stock was Banco Bradesco, which is a Brazilian company listed on the New York Stock Exchange. So I found that company, I'll say about 2 years ago. When I discover a company, so to speak, I don't buy it for at least 6 months. Often it's on the list for years. So this one had been badly beaten up. It had traded at, I think, around $13. It was now trading around $2. It's a bank, which banks can go under, but they're less likely to go under. They had made a profit every single year, so that looks good. It gave me a chance at some geographical diversification, but a lot of people right now, they might not want to invest in Brazil because of political instability. So once I discovered this stock, I put it on the list. I got the financial statements for the past 3-4 years. Often I will get the annual reports and go through those. So I like to get it in my hands, although it's harder to do. There's something about the tactile nature of that I enjoy. Of course, I do an incredible amount of investing from stuff online, which is where I do a lot of research. I don't think I'm a Luddite, but I do like that tactile facility. So then I just followed the company amongst many others. And at first I didn't really follow it that closely because, again, I know I'm not going to buy it for at least 6 months. So I'm watching it, seeing what it's doing. And in the case of this company, for the most part, it's continued to go down. So this is a company that traded at $13 not so very long ago. And now it was trading at around $2. So finally I decided, this is the one company that I'd really like to buy. Again, that's unusual. Normally I'm buying 4 to 6. So whenever I put in a bid on a company, I put on my cheapo hat. I try and buy it for as little money as possible. And it doesn't matter to me generally if I get the company or not. So I look at it, I decide, okay, how much do I want to buy? I have a system of 1 to 4. 4 means I'll buy 4 times as much as a 1. And that's based on the company. That can be partially based on the stock markets. There's a number of factors that go into it. And then I put in a low ball bid, and I think it might have taken about a week to hit. And then it hit, and I paid. I think I bought that one through web broker, so I paid them my money, and now I'm just sitting with it. Whenever I buy a stock, I always have my target sell price. So I always set that before I buy something. So what that does is it grounds me. And again, it's usually at least 100% more than I pay for the stock. Sometimes it can be less, but that's unusual. So in the case of this stock that I paid around $2 for, my initial sell target's over $10. Now, a lot of people would say, and I used to get this more in my early years of investing. I remember going out with David Hosey, who was one of my stockbrokers. He was a real stock market guy, tons of fun. He was old, he was 10 years older than me, maybe 15. I was mid-20s, but we got along swimmingly. I still remember going to meet him downtown, and we went to one of the bars near where he worked, and he was your typical stockbroker, maybe not completely typical, but he could pump back the year. He was real old style. And me, I was a lightweight, like a real lightweight. I'm still a lightweight drinking today. I enjoy drinking. I like having some wine with dinner 3-4 nights a week. But, I mean, he could pour it back. So I couldn't keep up. But it hit me, and we talked a lot, and I gave him a copy of my investment letter. It was first, second year, and it had all the initial sell targets of the stocks we had. And David was looking at it and shaking his head and going, Benji, 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 like, what are you doing here? You know, you've got a stock that's at $2 and your initial sell target's $8, and stock that's at $4, you're targeting it for $12. Like, what are you doing? Anyhow, a year later, we went out again. We did some golfing. I'm sure he whipped my ass. And then we sat down, and he looked at the latest copy of the investment letter. And he said to me, you know, Benji, now your initial sell targets make a lot more sense. And I said, David, the sell targets haven't changed. The stock prices have moved. And effectively, you know, if you've got a stock at $2 and you say you want to sell at 10, and later it's at $4.50 and you want to sell at 10, well, it looks a lot more sensible. But we've been looking at these home run and grand slam returns forever. So, you know, now with Bradesco, I'll just sit back, I'll monitor it along with the other stocks that I own, the other stocks that we look at. But, you know, Robin, you know, I'm fairly inactive overall. And if you look at the stats, if you look at the probabilities, in terms of investing in stocks, less is more, for the most part, not always. It's not a perfect equation, but people who do less generally do better. And by setting that initial sell target that I mentioned before, that does ground me, and it means I'm not constantly thinking, oh, maybe I should be selling now. The stock has gone up. It's doing well. Okay, it's halfway to the sell target, but, you know. Or maybe the price has gone down. Or maybe I should jump out. Again, I continue to monitor it. I will look and see if I should take a tax loss on the company. But I'm not jumping around like a jumping bean in any way, shape, or form. I try and stay calm and disciplined. And in one of my books, The Uncommon Investor, there's one page, and the whole page says, without discipline, you have no method. And that's it. So whatever the methodology one has, I think it's key to be disciplined. That doesn't mean over time your discipline can't change. That doesn't mean over time you can't tweak things, as we've done over the years. But it's important to have a good base and not be jumping around and reacting to the markets and basically saying, okay, this is what I want, this is where we're at, this is what I plan to do.
And so, speaking of discipline, have you found, Benj, that, you know, if you look at 1992 till now, there's just less people who are practicing the discipline of contrarian or deep value investing that you do with the rise of passive investing with ETFs, etc., that follow the indexes. Do you feel like a lonely kid in a candy shop sometimes when you're scooping up some of these mispriced equities?
I don't. Excuse me. You know, I work at home. Ben Stademan works at home. Philip McKellar works at home. My son Kalen works at home. So it's not a lonely existence at all, but I love it. I mean, as you've been to my place, you know, it's like we're exceedingly happy here. It's a wonderful place to work in. I can walk on the path. I walk down the hill, and I can walk to the lake. So I certainly don't feel lonely. I mean, I think a lot of it's personality. And in a lot of ways, I'm an extrovert. In some ways, I'm an introvert. I love being with people. I love being on my own. I kick back and spend a lot of time on the couch, one leg up and reading. So for me, it's all very comfortable. And I think if you look at some of the best investors out there, Warren Buffett comes to mind, Charlie Munger, may he rest in peace, comes to mind. But a lot of these people, they're not necessarily loners, but they do a lot of research and they do a lot of reading. So I would suggest to anybody who's watching this that one of the best ways to invest better is to read and read widely. Not just about stocks, but about other things. And that's an incredible way to get your system in place and to operate. And I think it also helps with discipline. So I'm, in many ways I'm in my own world. At the same time, when I get close to buying a company, I will use Ben and Phil and Caleb and maybe some other people as a sounding board to see what they think. Because I know, doing this for 30 years plus, and just the way I am in life, I make lots of mistakes, plain and simple. And I will always make mistakes. This is a given. The key is to try and make fewer mistakes. And when you make a mistake, to try and rectify the mistake sooner rather than later. But I love the business model that we've set up. Hopefully we'll keep it going for a number of additional years, and hopefully we'll have the same kind of returns.
Absolutely, and the returns have been exciting. While the process is boring to most, the returns have been exciting. 19% annualized over the past 10 years. And the reason why I asked you the question, Benj, is because I just find it so intriguing. I think the viewers of this show will, that the market has changed so much. While there's been so many trends that have come and gone, you've stayed disciplined, right, since 1992, and the results have been the same. So you're almost fishing in a smaller pond, but the results still show. They still prove that it works.
Well, I think it does. I mean, we talk in cycles a lot, and there certainly are cycles. But a lot of cycles are relatively the same. So it's very important to recognize when the markets are really high and overexciting, and when you think a turn might come. Now, when I'm looking to sell a stock, if I think the markets will turn, I won't sell that stock based on that. I'll sell it based on the stock, and maybe a little sooner because I think the markets will turn. We know there's going to be another blowout. The only question is when the next blowout will come. And then when the markets are badly beaten up, again, that's a good time to be buying, and buying more, have the fists out, so to speak. So again, a big key is staying grounded. A big key is having a system that works and that you feel comfortable in, being willing to change it to some degree when you make a mistake. But overall, I think a lot of people make the huge mistake of getting scared of the market at certain points in time, often when they're badly beaten up, which is the worst time to really be scared. And often, everybody gets really excited and they're blowing up their big balloons when the markets are great. They're letting off their fireworks. And a lot of people at that point don't want to sell because, we know that greed is a big factor to play in this. And we know that fear is a big factor to play. And as they say, be greedy when others are fearful, be fearful when others are greedy. And by working against the general philosophy in the market that way, odds are you're going to do far better.
Yeah. You mentioned two of your books. I have the original right here. I'm going to put it on screen. The Uncommon Investor. This is absolutely out of print, I'm sure, right? I think it's impossible to find. I had to find that in a thrift store downtown Toronto. I believe it was Riverdale. And
Okay.
then this, the most recent, the Contrarians Investors 13. I get a lot of questions, Benj, about one particular page, and it's one that we reprinted in my own book, Market Masters, your chapter. And
Wait
it's
a
what,
second. Did I know about that? I'm kidding. I'm kidding. Yeah.
oh, I'm not going to receive a legal letter, am I?
No.
And
You're not getting a Christmas card this year.
it's page 15, Benj, in the Contrarian Investors 13, and it's what you call the point tally system. And you have, I think was it around 20 points here. If we can walk through them, and your system basically says, I'll just read from the page here. If a stock warrants 10 points on the scale when you add everything up, after you go through the framework here, then it represents a buy possibility. Possibility, obviously, not a sure thing. Stocks below the threshold are not quite ready or far from ready to become part of my portfolio, and maybe they're on the watch list on the bench. If we're to go through them, the first point in the point tally system, when you look at a stock, the recent downward share price spiral. If there's been a downward spiral, that would be a -1. Can you talk more about that?
This is fun. This is fun going through it because I haven't looked at it for a
It's
while.
been years, right? Yeah,
I,
let's do it.
I appreciate you doing this. And I was just looking at one stock yesterday and today. And we buy stocks that are badly beaten up, as we've said, but we don't generally try and catch a falling knife. So there's a difference there. I like to wait until a stock has kind of troughed and been there for a while. So, it sounds far easier as I'm saying it right now. Sometimes you'll get certain stocks that do drop like a falling knife, and part of that can be just stock related because they come out with bad numbers, or somebody who owns a big position decides to dump, or it can be market related. If the whole market's taking a beating and the stock does, that is less negative for the stock itself. So again, I like to see a certain trough form. I like to see a stock often that's gone up and down, up and down, up and down, and then try and buy towards the bottom then. But catching the falling knife is difficult. Now, because as we mentioned before, I follow a stock for such a long period of time before I buy it, that gives me a better idea when, okay, there's no real reason to be fearful here. It's not a huge reason. So maybe it's just time to buy. But as I said before, and a lot of people who I'm sure you've interviewed and we've seen, a lot of those people, they never make mistakes. I don't know. I don't know how they do it. They're friggin' geniuses, those guys. Or maybe they just have better crystal balls than I do. Mine sometimes gets murky. But I do make mistakes. You know what? I'm gonna show you this now because it's in front of me and I love doing it. So I don't know how well
Yeah.
can you see this? Oops.
Northland Bank, right? Sure certificate, it looks like. Yep.
So this bank I bought many years ago, and it sits on one of my two desks to tell me how stupid I could be. And that stock went bankrupt, I'll say 20 years ago, which might mean 25 years ago. And back then I was a much younger Benj Gallander and learning more and learning from my mistakes. And there's two major things to learn from. It's one, what you do right, and one is what you do wrong. Now, Northland Bank, I believe I bought it 4 times because every time it was cheaper and every time it was a better deal. Now, what I ended up with, I don't know if I've ever shown you this before.
You haven't.
I ended up with
That's
a
a
share
reminder.
certificate. It's a beauty. It's a beauty. The problem with that share certificate was it cost me an awful lot of money. So it reminds me again how fallible I can be. So the thing that I've learned over time is I will only average down on a stock once. Even though I maybe feel quite sure that when the stock goes down again, it's a better deal, I'm just going to say, Mr. Market knows more than me. he's more, she's more in tune with where the market's at. And I just might be too caught up in something. So, that's something I've learned over time. I know people and people I work with, they'll average down more than once. I simply won't do it. Now, if I think I should average down and I don't, and the stock goes back up again, then I still should make quite a bit of money. I won't make as much as if I average down. But that's okay. There's lots of other stocks that I have. There's another fish that'll come along. But yeah, Northland Bank sits here and tells me, And,
Before you
and
pull
over
that
the
next
years,
trigger, right? Exactly.
yeah, I've invested in a lot of bank stocks. When one of the U.S. Bank sell-offs occurred, I bought 4 or 5 U.S. bank stocks,
Yep.
and did phenomenally because, my sometimes I like to think that what we do is fairly complex, and we try and get the extra 0.25% point, the extra point, etc. But a lot of what I do, it's not so complex. So with that, it was like the markets were getting killed and the bank stocks were getting killed. And I just thought to myself, Benj, the U.S. banking system is not going to end. There's going to be some banks that are going to go bankrupt, but if I buy a number of banks, there's going to be some that are going to do well, 2, 3, 500% returns. And I think that time there was one that didn't do well, and the other stocks, again, I think there might have been 4 others, did phenomenally well. And of course, once they return to form, and the economy and the market returns to form, so to speak, they will go up multiple times, and you can have incredible returns. So what I love, just to do a little segue, not that I ever do segues, what I love is when a sector gets killed. It can be oil and gas. It can be banks. You choose a sector you want to choose. And if that whole sector gets killed, that tells me that there's probably some good cherry picking that I can do. And in the banking sector, I figure about once a decade, it gets absolutely slammed. It'd be interesting to look at a graph of how often it happens. And again, you just have to try and avoid the ones that are going to die or get absolutely reamed. And again, you won't be able to do that necessarily. So you do the best you can. I do the best I can and go from there.
And when the U.S. banking sector gets slammed, there's more opportunities to cherry pick because you have these smaller regional banks, right, in the U.S.
Oh, no question. There's tons, but Bank of America I picked up at $6 and change. I don't know where it's at now. I sold it over 40. Continental Illinois Bank I bought for a few dollars. So major bank can get killed, and investors say, well, it's over. The sky is falling, and the sky can fall to a degree, but it's not going to fall everywhere. So it was a great time both for big banks and for small banks. Here we have such a different system with our major banks. And I own, just to mention, I own Laurentian Bank, which is, it's still a major bank, but it's smaller. So, that one I think is a good one. But I didn't buy that anywhere at a price point like I was buying these U.S. banks.
Yeah.
And the U.S. banks, there's so many of them, and so many that get badly beaten up, and it gives you a lot of choice. So choice can be a wonderful thing.
The next point on the point tally system, it goes back to your price target discipline, Benj, where the point reads here, is it a single, a double, a triple, or a quadruple price upside? And you would apply a point of 1, 2, 3, or 4. Mm-hmm. Walk us through that. How do you determine your price targets?
What I do is I go back 10 years, the stock prices for the past 10 years. And if I can see, let's say for 7 of the past 10 years, the low end of the price is a lot higher than where the stock is now, there's a good chance that it's going to get at least that far. And then at the same time, I'll be looking at the higher end and see, so maybe 7 of the past 10 years, the stock that I've bought at $3 has hit $11. So there's a good chance, if it's 7 out of 10, 70%, that it could get back there, ceteris paribus, all things being equal. So then I'll take a look and try and target a price that seems reasonable. Now, a key with this, Robin, is that none of it's pie in the sky. It's all based on where stocks have been before. So it's far different than people who are buying IPOs and are hopeful that the stock will go up, X number of times. And, again, having invested for so long, in my early days, I would sometimes buy into IPOs. A very good friend of mine in high school, he became a broker, and at the place where he worked, Yorkton Securities, they were big promoters of IPOs. And I didn't know very much. I was reading and learning, and so I got into the odd one. Sometimes I did fine, and other times I didn't. Which, just as a possible segue, it tells you, you have to watch what is the mentality, what is the reason the person is selling you the stock if they're pushing it on you. So setting a sell target, I wish it was more scientific. I really do, but I go over where the stock has been. I say this seems very reasonable. I set the sell target before I buy the company, and I rarely ever vary it. And then I sit back and wait. Now, what could happen, say, is if the stock hits the target in November, December, then I might say, as I think I referred to before, I'm going to try and defer taxation and wait until the new year. Plus, at the end of the year, you often get, the Christmas rush, so to speak, the Santa Claus rallies we talked about, and the January effect. So you've got a reasonable chance that in most years, that stock is going to continue to go up at the end of the year, which means you can get, again, 0.25% more, 0.5%, a few percent. We just had one stock that my associate sold just the other day in the first few days of the year. I prefer to wait a little bit longer, but he decided to sell. He did very well on the stock. I mean, we're still talking hundreds % return. But again, I might have waited another day or two, and he decided Phil is a very, very smart guy. And there's certain things I'll do, and he'll think no, and he'll be right. But you learn, and again, patience is key, as I mentioned before. But setting that sell target, when you're setting it at such a distant price target, it means you build in patience. Now, what also can happen is sometimes you have a takeover. So you buy a stock at 3, the takeover price is 6, and the initial sell target is 12. Well, then I wait, and normally I wait until the takeover happens, and then I sell at that point in time. It's very rare I will sell a stock that's in the midst of a takeover earlier than the takeover happens. What I'll hope for, which sometimes happens, is that another party will come in and say, I want to buy this company too. Again, I know it's another segue. And ideally, get into a bidding war. And Benj will sit back and say, go guys, go. Bid that stock up. And I'll just sit and wait for it to fall into my mitt.
And that's just the nature of your investing style, right? There are a lot of takeovers that have happened over the course of, let's say, 30 years. And if people go onto your website, Contra the Herd, you have a page dedicated to just that, the companies you invested in that were taken over. And there's some great case studies there going back all those years. The next point here, Benj, is negative margin of safety. So you'll apply a -1 point there. Can you talk about that negative margin of safety?
Well, if there's a tremendous amount of debt, that to me is key. I don't like to see an awful lot of debt on the balance sheet. If there's a lot of debt, I like to see that the debt is fairly stable over a number of years, or perhaps the debt has come down quite a bit. But certainly there's a lot of companies I look at with big debt loads, and normally I end up ignoring them. Again, a lot of them get put on the back burner on my stock watch list, and I'll just sit and wait. But I will knock off a point and say, this really has certain negative characteristics, and one has to watch when they're looking to buy a stock that they don't get caught up in all the positives, which is also something that if somebody is proposing that you should buy a stock, again, know where they're coming from. Are they just looking to get a commission, or is it something else? Do they really know the company well? But in many ways, it's more important to highlight the negatives of a stock than the positives, because it's the negatives that are going to get you in trouble. So I'm very cognizant of what can go wrong and why it might go wrong. And when I'm looking at a company, once it's past the initial filter, and I'll just go over the numbers and say, this doesn't work at this point in time. It's just too risky. And there's generally good opportunities, far less today than I think maybe I've ever found in the past. So what does that mean? That means for me, there's no compulsion to buy. I'm being very selective. Again, I'm cherry picking. But putting a negative number on something helps keep one rational. I consider myself to be an optimistic realist. I don't want to be an optimist when I'm buying stocks. An aspect, sure, but I also want to make sure I put on that cynical hat and say, what can go wrong here? Because that's what's going to kill me, and that's what's going to hurt my returns and take money out of my bank account.
Certainly. I remember talking with Mark Cohoides years ago, the infamous short seller in the U.S., and he said, will people care if this company goes away? And if the answer is no, then that leads him to basically short the stock. It's the last question that he asks himself.
And in line with that, I sometimes say never fall in love with a company. It's not going to love you back. This is a business relationship, essentially, is what it is. You're buying into it because you think there's a chance to make money. It's different if you're buying into the company of a friend and trying to help the friend out. But when you're buying on the NYSE, the NASDAQ, the TSX, they don't know that you're doing it for the most part. The companies don't really care. You're forming a very distant relationship, and there's primarily one purpose, and that's so you can make money, better yourself, better your loved ones, maybe help other people out. But the company isn't going to love you, plain and simple. And you have to be wary too. I often talk with management before I buy a stock. And you have to watch to make sure that you're not just dealing with a sales job. And I think as the philosophies will go over, we may hit that one. But very, very important, to use your brain, use the left hemisphere, use the right hemisphere, let them commingle, have a little dance party go on in your brain, and try and come up with something, fireworks that'll work so you'll get good returns.
Yep, absolutely. The next point here, stock is likely to undergo a share consolidation. And that would be a minus 1 point. The stock is likely to undergo a share consolidation.
Yeah, share consolidations hurt. Almost always they hurt the stock price. So if you've got a stock that gives you 1 share for 2 or 1 share for 4, 1 for 5, some people think that it's linear and the stock price should go up relative to the consolidation. And it may momentarily, but generally I found historically the stock price gets hit. So I've actually sold some stocks once the company says we're going to have a share consolidation. And then I'll just sell it, get out. It will likely go on the stock watch list, and I could buy back later on. But stock consolidations, excuse me, they're a killer.
Mm-hmm.
An absolute killer. And, there's a lot of rules that we use. We've got rules for life. We know you exercise to stay fit. You exercise to stay healthy. With stocks, the same kind of thing. Certain tools you use and certain rules to follow to stay healthy with your investments. And again, some of it's much more complex and some of it's far simpler. And right now, in some ways, it's easier than ever to invest. I remember when I started, I would go through the Globe and Mail, the newspaper I write for,
Mm-hmm.
going back a long way, and I'd go through the stock listings line by line. This is pre getting it on the computer. I mean, now I can just do a fast filter and find the stocks that have gone down 50% in the past 52 weeks. But back then I couldn't. So I had to go over it all, and then I would mark down all the names, and then I'd look more closely at the stocks, and then I would contact the company by sending them my little letter and saying, can you please send me the annual reports for the past 4 years? It was certainly far more labor intensive. I mean, I still send them an email now, but that takes virtually no time. The letter's already done. So certainly things are a lot easier in many ways now. Now, how that improves returns or how it hurts returns, I can't say overall, but I'm sure there's some sort of impact.
Yeah, so this leads to the next point, and you've alluded to how challenging this can be. It's is a good or excellent management, basically. How do you evaluate management? What are the green flags, the red flags that you look for?
Well, often I will meet with management. Often I will call up management and talk to them on the phone. Often I will look at management's history. Have they, say if they move over to a company that I'm interested in, I'll look at their track record and see if they have a good history of turning around companies. That's very meaningful. And there's certain guys, that's what they do. They go in and they turn around companies and they make themselves $1 gazillion, and I mean $1 gazillion, and then they move on. So people like that are great, but even that doesn't always work. I remember one company, a guy who had success turning around companies, and Yas moved to one of the companies I was quite interested in. I thought, okay, this is it. And Ben Stadelman, my business partner, we both thought this is it. We sat down with him and we talked it over, and it all sounded very copacetic. It's a word I love, by the way, copacetic. I don't get to use it enough. And it all made a lot of sense to us. And within, I think, a year, the company had gone bankrupt. Obviously not a good investment. So where did we go wrong? We put too much faith in the management's track record. I don't think it was, retrospectively, I don't think the track record was quite long enough and successful enough for us to invest the way that we did. So if somebody, I've seen people, and this to me is fascinating. There's certain people who become CEOs of companies, and if you look at their track record, they go from company to company, and they go for 2 years. Or they go maybe 3 years if they fall asleep. I don't know. But they're constantly switching companies. Now, why is that? Is it because they need a new challenge? A lot of them, I don't see them doing really good jobs. Is it because they get the boot and companies need a new CEO? Is it like some baseball players and hockey players? They manage to go from team to team and they're never that great, but they keep it going. But I see certain people who manage to do that. And I like somebody who comes in and does a turnaround. And then after the turnaround's done, maybe they take a bit of time off and they go and do another. Now, way back in the day, I used to go into small companies and do turnarounds. And it's a wonderful thing to do. It's fascinating. If you can go in and save jobs and have a company survive, it's very, very gratifying. And I mean, now I'm investing in companies where I'm hoping there's somebody who will do the same thing. But some companies I invest in, they'll have had the same management for 10 years plus, and management can own quite a bit. But the simple fact that I'm looking closely at the company means that the company has really been beaten up. Now, is that because the management has lost its way? Could be. Is it because of the economy or the stock market gets killed? Could be. I have to decipher just why that is. And when I'm in the right mood, and I'm not always in the right mood, looking at companies and discovering, so to speak, companies, it should be like a treasure hunt. You know, here's something, I'm looking around, I find something, this one doesn't quite do it, this one doesn't do it at all. Well, this one makes sense to me. And then I throw in my bid and see if it actually hits. But it is, in a sense, looking for a treasure, again, so to facilitate lifestyle and buy those good dinners that we like to eat and take us on the trips.
Wine, right? The good bottles.
Yeah.
So, Benj, this is totally new to me that you're an activist investor early on. The companies that you helped turn around, what was the first 90 days like for you? Talk to us about the commonalities. Like, what changes would you implement right away?
Well, what I would do is I would talk to the people who work there. The people who work there, the people who are on the ground floor, would know the company way better than me. And a lot of those people really want to have a voice given to them. So that's key. You go with the people there. They're often very happy to help out. They want to see a turnaround. Often their livelihoods depend on a turnaround. A lot of them might have been depressed for a while because the company's doing so poorly. Mm-hmm. So if they see someone like me come in and they think there's real hope there and this can impact their future, that can be very meaningful for them. But the key to me is to talk to the people and to know, I mean, so many people know so much more than me in virtually every field. Just ask my family. They'll tell you how little I know in so many ways. I'm not calling them in right now. They could come and say, oh yeah, Dad, yeah. I mean, he's got some good things, but you know. So the key is to have an idea what you do know and to have a good idea what you don't know. And to try and have a good idea what the people there know and to get on the good side with them. And I was reading about one company the other day, and you know, I think it's the new management had gone in, or the turnaround people, and you know, they were talking with the people. And it's critical. The people on the ground floor, again, I'm being a bit repetitive here, will know more than I know. So, you know, time can be of the essence of a turnaround. At the same time, you have to get enough knowledge to make the turnaround happen. Yep. And that's key. And it can be a lot of fun. I remember when I was doing a turnaround at a small newspaper, and it was a long time ago. I was quite a bit younger. And my dad, who was a very good business person, he was in the lumber business. He had lumber yards. In Toronto, he had one called Warden Lumber. He owned some other yards. And he was one of the people typical of the time. He had a grade 11 education. He went to work for his dad in a very small lumber yard. You know, people at that point in time, they weren't, for the most part, getting university educations. They had to go out and make money to make ends meet. And my dad was there, and he was loving it. he was loving hearing my stories at the end of the day, what was going on, and giving his input. I think he was happy to know that his son was actually doing something that might have some importance for some people, and to know that I wasn't just sitting on my butt twiddling my thumbs, because I always was good at that. I mean, I was pretty much an A student at that. And I would get up in the morning and go to work early and work long days and try and think things through and talk to the people who work there. And then I'd have to talk to suppliers and convince them, yes, you were going to get paid. I know, we owe you 6 figures, but the plan is to pay you. And if they said, well, I don't know if we want to work with you anymore, I say, well, that's your option. But if we don't survive, maybe you'll get 10 cents on the dollar.
Yep.
What I'm proposing is to pay you 100 cents on the dollar, but it's going to take time. So it's better to get 100 cents on the dollar within 2 or 3 years than 10 cents on the dollar now. Just the way it works. Excuse me.
The next point here, Benj, and this is a tie-in, is management's ownership position, their insider stake in a company. Why is that important?
Well, that aligns management with shareholders. If management has no flesh in the game, except they may be making a salary, it's less worthwhile for them to work hard for the company and do really well. If management owns a lot of shares in the company, they're going to want to do more to make sure that it turns around. So I like to see that they have that flesh in the game, that they're aligned with us as shareholders in a meaningful way. It's very, very important that they do. So, you can. It's easy to find the numbers generally and find out how much the management owns within that company. And it's also good to see if they're buying shares in the company. I don't mean getting options.
Open market purchases, right? On the open market,
that's
I
right.
assume.
Making actual purchases.
Mm-hmm.
And they're saying, we believe in this, we're putting our money into it. Conversely, if management is selling a lot of their shares, that's not a positive. I saw somebody recently trying to spin it as a positive, management selling a lot of shares. And I looked at it and said, oh, you might be absolutely right, but I don't get it. It makes no sense to me. If management's selling a lot of shares, now it could be because they made an awful lot of money, and at a certain point they want to cash in. But generally, management selling a lot of shares to some degree is a negative indicator. And if management doesn't own a lot of shares, that's a negative indicator. I want to know that they do, that they're aligned with me, and that we're looking at the same goal with the share price going up quite a bit.
Yeah. So you touched on the next point, insider trading. So you are looking at recent activity. You're looking at specifically the selling activity. The next point here,
I am looking at buying activity too. Mm-hmm. If they are buying in the open market, to me that's meaningful.
They have conviction of the turnaround that could be taking place.
Yeah, because they're saying, I'll put the money on the line. I assume that they're thinking I'm going to sell this at a higher price. So that is also very, very meaningful. So if they're buying and adding to their position in the marketplace, yeah, that's important.
The next point, excessive versus equitable executive compensation. I'm sure you've seen some executive compensation. That does not make sense at all. So talk about some of those stories, Benj.
Well, a lot of management, they can be very, very greedy. Look, you look right now at one of the greedy guy, Elon Musk, and I have tremendous respect for the guy in terms of what he's done business-wise. Some of his trains of thought, I question, but the guy's obviously a genius.
And an investor could correlate the outcome that he's achieved for investors to an equity package that big. I'm sure you've seen salary packages are not proportionate to the value that CEO is delivering, right, for the company.
Oh, absolutely. Yeah. And I think it's almost criminal. It can be criminal if they're taking way, way too much money because that obviously can't go to shareholders.
Yeah.
And a lot of management's going to justify it. I mean, Elon could say, "This is my company. I built the company. I deserve to reap the benefits." But like, you know, how many cars can you drive? Oh, well, it's a Tesla. How many cars can you drive? How much food can you eat? You know, a lot of it's just greed. And because the stock market is such a capitalist thing, it attracts a lot of very, very greedy people. And if the executive is making too much money, that money cannot go to the shareholders. And there's something very distasteful to me when they do that. And, you know, I can understand it on one level, but I do not like it on any level. To me, it just seems wrong, plain and simple.
Yep.
I think some people get their priorities so out of alignment that it not only screws up the investors in the company, but that it's a bit of moral decrepitude. I don't know if I've ever said that before, but it is. Morally, they're corrupt in a certain way. And I'm sure a lot of them just go and look at themselves in the mirror and say, "Yeah, baby, you know, who knows? The next president of the United States could be, you know, one of those people." I'm not saying he is, but it might be worthwhile thinking about it. Next Prime Minister of Canada, who knows? But there's a tremendous amount, again, of greedy people out there in corporations, and it makes more sense, excuse me, that it's more with corporations and capitalism than it's, say, with, you know, Mother Teresa and other people who are working in the field. You know, there's different motivations, and capitalism isn't always a good one.
Yep. Here's one. High research and development expenditures. This would be favorable. You would add a point for high research and development. Explain why.
Well, if a company's doing research and development, that means they're staying up,
Yep.
or should be staying up on what's going on in the field. So that's key.
Yep.
Some fields obviously need more research and development than other fields. So to know that a company is spending to keep up and to push ahead of competition, that can be important. Now, the question then becomes, is the money being spent wisely? Because often money gets wasted. And sometimes corporations have too much money, and they therefore spend it wastefully. In that case, it's better perhaps to buy shares back depending on the price. Too often I find the companies buy shares back when the price is high, and that actually hurts investors. Or a good thing to do often if you've got lots of money is to pay a dividend or increase a dividend or give a special dividend. I love getting dividends. Dividends, as you might have heard me say, they allow me to be stupid longer. It's plain and simple. If I'm getting some sort of return on my investment, that money is now back in my pocket. I might blow it in another way, but hopefully I won't. But once it comes back to me in terms of a dividend, that's generally a positive thing. And of course, we also have the dividend tax credit. So given that you're paying less tax on the dividends, that's a great thing as compared to, you know, working for your money and then paying whoever the prime minister might be or who's ever in government, you know, what we have to pay in taxes. A key thing, Robin, as you know, is what's in your pocket at the end of the day. Yeah. And how do you try and make that at a maximum level in terms of your investment? So that's very, very important. That's what you're looking to do with stocks. Again, you know, stocks don't love you. There's no reason for you to love them back. Yeah. You want to love the dividends that you get and maybe go out and enjoy them somehow. You know, that's what this game is about to a large degree. It's not the whole game, but a lot of it.
If we were to look at all of your holdings in your current portfolio, Benj, What percentage of the companies are paying out a dividend currently, would you say?
That's a good question. It's over 50%. I think it's closer to 60%. Now, part of that is because, well, I love dividends. Part of it is because I'm not buying any companies that haven't been around for at least 10 years.
Mm-hmm.
So they're generally more established. You know, the dividend gives them a point in the system, as we've alluded to before. But to me, it's important. Now, what's going to kill an investor, and it's hurt me on numerous occasions, is when a company has a dividend and they cut it back. What hurts even more is when they eliminate the dividend. Yeah. And I find often enough when a company cuts its dividend back to a degree, later on they end up eliminating the dividend. So in almost every circumstance, not everyone, when the company reduces the dividend, the stock price takes a hit. Mm-hmm. It's very rare that doesn't happen. It can happen. It can be because investors then think, well, now the company's going to be on a better footing, and that can be very true. But for the most part, people have been counting on the dividend, and the stock price goes down, especially when it's eliminated. And one thing to watch for, and I learned this the hard way a few times, if the dividend gets too high as a percentage of the stock price, so as a figure, I would think maybe 7% plus. If that happens, it's often a clue that the dividend's going to be cut. Mm-hmm. And if you can anticipate a dividend being cut, that can be a good time to get out. Now, I would not just sell for that reason, but as I said, in almost every case, dividends cut, stock price is going to go down. So you don't want to buy, at least I don't want to buy, a company that's paying too high a dividend relative to the stock price. Clear indicator there's a problem.
If you're a betting man, Benj, Bell Canada, BCE, I think it's around 12% dividend yield. Will that be a cut or not? What do you think?
That's a great question. I owned BCE at one point. You see, for a company like BCE to cut its dividend, I haven't thought about this at all, but I love the question. You know, that would cut them to the core, because this is like, you know, is it one of the blue chips of blue chips over time?
Yeah, it has been for years. People rely on Bell to pay out dividends.
Mother Bell. Well, that is an indicator. I'd have to look more closely at it, but it is a good indicator that it could be cut back. I mean, that space has changed so much over the years. There didn't used to be many companies, and now you can get a lot of more adept companies. I don't know what Bell has done in terms of layoffs or what they may have to do in terms of layoffs, but they may have to, as they say, right-size the company more. Mm-hmm. And, you know, that's always something that I hate to see when people are losing their jobs. It's rare that this is a good thing for people. Some people, maybe it can be a good thing to get kicked out of the door, especially if they get a good package. But as a general rule, you know, this isn't good for people. This hurts people. This hurts families. And some companies we've seen, they can do massive layoffs. Mm-hmm. Layoffs are better than bankruptcies. Mm-hmm. But, you know, I always try to avoid doing any layoffs, plain and simple. Now, there's different ways of doing it. One is, again, to turn around the organization. I've seen some organizations be creative, and they basically say to the employees, why don't we reduce everybody's wages by X percent? Mm-hmm. And if we do that, we don't have to lay anybody off.
And then it's up to the employee themselves to say, I'll take the cut or I'll just move on to another company. Yeah. Mm-hmm.
So, you know, this can be a very cruel world. Ideally, people maintaining their jobs makes it a less cruel world. So to me, that makes sense to try and do that. Excuse me.
No
I'm not
problem.
used to
We'll
talking.
see how that materializes at Bell. I don't think they've ever been in a situation with the yield this high. So stakes are absolutely high for management now. The next point here, I'm curious if you still use this in your system, Benj. It's whether a company has favorable demographics. And if they do, you'd add 1 point.
Oh yeah, certain companies in certain fields, they're very much demographic plays. So if it has certain demographics and that it seems like the population is changing in a way that'll be helpful to the companies, that's still important. Now things have certainly changed. You go back 50 years, you didn't see so many women in the workplace. In terms of the diverse nature of Canada, it was a completely different country back then. But demographics can be important looking ahead. Even something like how many babies the average family has. Back in the day when I was born, it was much more common for families to have from 4 to, say, 8 kids. I don't know the exact numbers. What's the number today? 2.2? I mean, the third one,
If even, right? It might be 1.5
it might be one
in
and a half now.
2025. Yeah.
Yeah, you have to slice and dice in a different way. That's a horrible joke. Um, but, it's certainly changed.
Yeah.
And a lot of people are very concerned because the population will not be growing as quickly, if at all. I think that's a wonderful thing. I think it would be ideal to stabilize the human population. I mean, we've gone from 2 billion people. What are we at now? Do you know the number these days?
Oh, geez. Was it 8 billion?
I was going to say
Hovering around there? Yeah.
So if you look at the short time period in which that's happened, I think of the locusts going over the fields, and we're becoming way more like locusts because we have to feed all these people and house all these people, hopefully. So it's very, very dangerous. So to my optimal way of thinking, which disagrees with a lot of people, I don't want to see any more growth. I think that would actually be very healthy. Other people say, well, you grow or you die. Well, no, you don't necessarily grow or you die. You can stop growing and stabilize. You can even shrink. So looking from where the population was to where it is today, would it be so bad? And I'm not hoping that we have something that wipes out a huge population, a major catastrophe. Would it be so bad if we went from 8 billion people down to 6 people, but in a natural way? In a way that people decide, I don't want to have kids, or I just want to have one kid. Now, some people, I'll hear them say, well, that's selfish. You don't want to have, 4 kids, whatever. Well, no. It's another way of living a life. Now, I feel very fortunate. I've got 2 boys, and I think they're pretty wonderful kids. You're now in the father fraternity, so, you're
Number
seeing
1.
what it's like. And it can be wonderful. It's certainly not for everybody. I'm very glad I did it. I'm also glad that my boys are now 24 and 20, and they're far more independent. My eldest, Caleb, he heads off for Thailand on Sunday, and he's got a one-way ticket, and he's going to go over there, and he's going after a few days in Bangkok to a scuba place. So he's spreading his wings and flying once again, and you'll see this one day, not for a while. But when your kids take off, and they're fulfilling their dreams. And, we went to the gym together this morning, who would believe? And, he's doing what he wants to do and feet in the ground. And when your kids do that, it means you've probably done something right. And I like to think that in this regard that Pascal and I have.
It sounds like a future trip for you, Benj. Maybe to, spend 2 weeks in Thailand, right? That'll be beautiful on the beach. right under the
I was
sun.
there years and years ago when I worked in Nepal, both on the way there and on the way back.
Hmm.
I stopped in Thailand. So I worked in Nepal for a number of months doing anti-poverty work. I stopped in Thailand and it was completely different. Now, the organization I was going over with, the Ontario Worker Co-op Federation, well, actually, it was a sister organization. They did anti-poverty work.
Mm.
And the woman who I went over with, Chantal Sylvie, who was one of these really good people doing all kinds of work to help people out. And she had worked in Africa and Asia, some in remote areas, to help people have a better lifestyle.
Mm-hmm.
And, that was wonderful for me. And I got to stop in Bangkok and spend a number of days and, get a taste of that lifestyle. And then to Nepal, one of the poorest countries in the world at that point, and still today. Different world, man.
Yeah, absolutely gives you perspective. So the next point in your system, you've already went over, right? Excessive or reasonable debt. I think I've heard you say as well, Benj, in the past, that some of your favorite companies have absolutely zero, no long-term debt at all, because can a company really go bankrupt, right, with zero debt?
I had one go bankrupt.
Okay.
Zero debt.
Tell us about that, the exception to the rule.
It was awful.
Okay.
It was awful. I thought, there's no way I can lose here. Management was old. Maybe they're decrepit, I don't know. But when that happened, that hurt. One would think it's an impossibility. One would look at it, in mathematical terms and say this simply cannot happen, that the company will go bankrupt here. But it did.
This is a good business case study for MBA students in the future, right?
I'd have to remember the name of the company. I'm sure I could dig it up. I might have tried to block it. But, debt is absolutely critical.
Mm-hmm.
Again, if a corporate debt is rising, unless it has a really good reason, I certainly won't buy in. If it's stable, sure, I could buy in, or if it's going down. But debt is critical to my system. Yep. And, when I went over to Nepal, and you see the world there,
Mm-hmm.
and you see the amount of poverty, and again, this was late 90s. In terms of what we have here, one has to be so thankful. We have so much here. I mean, there's people, of course, who don't have much, but overall, we're in a pretty good place. I'm not saying that it's perfect. I'm not saying that it can't be improved upon. But I think that it's very important that in our lives, we count our blessings. And as I said, being an optimistic realist, I think really helps me in that regard. But there's a lot of people in this world who definitely suffer dearly.
Absolutely. We have a lot of safety nets, don't we? When we're on hard times as Canadians in the country, there's safety nets, right, for people in the country. Where when we fall on hard times, there's always the government to help in some capacity. Yeah. So you talked about dividends, but here you talk about dividend payout. When does the dividend payout ratio become too high, Benj, for you?
Sorry about the coughing. I'm not used to talking so much. When does the dividend payout ratio get too high?
Mm-hmm.
Yeah, I think when they're paying out dividends over 7% or so,
yeah,
that's when it's getting too high. That's a good indicator. You can also look at just the payout relative to earnings and see how high it is there. But you really have to think about when it might be cut, as we talked about before.
yeah.
And that's very, very important. So there can be a clue when the percentage gets too high.
Mm-hmm.
And at that point, you have to think, well, should I be running from this stock? And if that's the sole reason, I would think long and hard.
Mm-hmm.
But yeah, at a certain point, one can see that the dividend's likely to get cut, and as we talked about, then the stock price is likely to come down.
Yeah. And the next point here, positive financial condition, goes really hand in hand with the debt load of a company. Preferably, there is no debt, as you said. And then you also have a point system here for amount of time followed. How long is a company typically, Benj, on your watch list before it becomes time to actually pull the trigger and buy?
Well, minimum of 6 months.
Okay.
Often it can be years. Remember when I bought Service and Stewart Corporation, they're both in the funeral business. And I had watched them both for a number of years before I actually did buy in. I miss more companies than I buy, that's for sure.
Mm-hmm.
And a lot of that can only be understood retrospectively. But that's okay. I know that I'm going to miss a lot. But by having a 1 to 4 weighting and time frame, often I've watched a company for years.
Yeah.
Years minimum, again 6 months, often 3 or 4 years before I will actually buy it. So, being patient again is key. I'm in no rush to buy. I'm willing to miss buying the companies. So it's, I'm used to it. Again, having done this for so long, I've gone through so many cycles, both in terms of markets and in terms of my personal investing, that there's not too much that can really faze me. There's somebody I work with and he'll go, oh, I should have bought that. I missed it, blah, 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 blah. If only I'd bid a penny more. Sure, and I get that completely. But again, I put in that price and I may vary it a bit over time, but overall, I'm going to sit with that price. I may lower it, I may raise it a bit if it's later in tax selling season, but I am happy to just wait and watch and hope.
Mm-hmm.
And move on. Now, it's an interesting time of year because, as you know, December is my high buying season.
Yeah.
I still do a fair bit of buying in January, some, not so much. But otherwise, for the most of the year, I'm pretty inactive.
Mm-hmm.
And that also, it makes my life easier. I'm still doing research. I'm still looking at things. I'm still studying things. But I'm not pulling the trigger and I'm not watching as closely in terms of buys. So, you as a new father, I'm sure that the way you spend your time has changed dramatically over the past X number of months. 7 months? Is that it?
7 months old. Yeah, there's not many opportunities to read, let alone even watch Netflix, right? I might get 5 minutes into a Netflix movie, then have to turn it off.
Yeah, and it's interesting too because a few years ago, if you had looked at how you spent your time
Yeah.
and thought about how much time a baby would take, like where were you going to fit in that time? Because I'm sure you were leading a very full life.
Yeah. Time is precious. And so when I do have the extra time, I allocate it in a very intentional way.
Mm-hmm. Yeah, absolutely. So there's a lot more focus. Excuse me.
Yeah. So
And
true.
that's-
It's just complete
that's
change.
key. And this is the nature of the stages of life. I mean, I talk about the stages of life in one of my books, and what we almost all of us go through, and life changes over time. You're going through a very, very particular, focused stage of life. All of a sudden, your focus and what you have to give is based less on you and your wife and is based far more on your child. Well, as my eldest, as we talked, he goes to Thailand. So this is the last week with him for we have no idea how long. But, it's like a bird leaving the nest, so to speak. He left it before too, and he's fulfilling his dreams. And part of the beauty and this is good for all of us, he knows. He knows what he's got. He knows how fortunate he is. And we were talking about Thailand this morning, and he was talking about, how little money he would need there. How he could live a really good lifestyle for next to nothing. And this is outside of investing to a degree, but how do you live a wonderful life? This is a big world. There's so much to see. Some people don't like to travel. I get it. Some people just want to go to the cottage. I get it. It's neither right or wrong. Here's my lad going to Nepal, which, I worked there at one time. And he's going to see this whole other world.
Yep.
And he's ready for it, but at the same time, even if you're ready to see what goes on, to see the poverty, and to see that relative to the lives we have in Canada, it's pretty stark. And, often again in Canada, we don't appreciate what we have.
Yep.
And it's very, very unfortunate. We get caught up in so many things that are going on. I mean, right now we're going to be caught up in an election, and for better or for worse, this is where we're going. I'll tell you one thing that I really dislike. I hate the mudslinging. And, politics to me has become, I know this is a real segue, far dirtier than it used to be. And there's certain politicians out there, and they sling mud on the opposition all of the time. To me, what it should be more is, here's my platform, here's what I'm going to do, here's how I'm going to do it. If this makes sense to you, vote for me. Rather than saying this other guy is a complete bastard, don't vote for him. Vote for my ideas. And I wish there was more of that going on now. I find a lot of people don't really put forward a lot of ideas. And hopefully some of the ideas are innovative. Hopefully the ideas that would help the Canadian people. But I'm not very hopeful on that.
And then the mudslinging now is become throwing mud over the border. We have Trump threatening to buy out Canada. And I have no idea where this is going, where the storyline's going, Benj. What do you think?
Well, I think I would ignore him. That's what I would do. I mean, the idea is so stupid. I'm sure there's some Canadians who would like to be a part of the States, but do we really want to lower our standard of living that way? Because I think that's what it would do. We're bigger than the States. We're in better shape than the States. I would just, say to him once, Donald, that's a really dumb idea. I'm not even going to address it anymore. It just makes no sense to us as Canadians. But we would be willing to buy Alaska for $1. Maybe a little more. I mean, I just say, Donald Trump and his ideas, I think there's many that can be questioned. Donald Trump and the lifestyle he's had can be questioned. But he will once again be arguably the most powerful man in the world. Can you just ignore to a degree the most powerful man in the world? I think you can. Just, okay, you make your rant. Okay, you say you want to take us over. It ain't happening, buddy. I mean, it could happen if they decided to invade us. I don't think that would take, very long for them to take us over. I don't know, maybe Russia would then invade from the other side. I don't know. But I just say, you know what? You've got your ideas. They make no sense to us.
Strange times, right, Ben? Really strange times. And yeah, we're going to be entertained for the next 4 years, it seems, right, with all this back and forth. So
and the key
going back to the
key thing there is, Robin, we've already seen this TV show. I mean, it's changed to
a rerun.
Degree, but he was already in power. He already served his 4 or 5 years. And we know who he is. Some people would say, I'm not saying it, but some people would say that he's more deranged now than he was before. There's checks and balances in place to a degree. I think one of the major problems is he has so many people kowtowing to him. And that is a danger not only in the States, but we've seen that in so many countries in the past, so many countries now, and that can lead to real catastrophes. But I don't think they're going to invade. And anyhow,
Yeah.
sad silliness that we have to deal with.
Yeah. Exactly. Book value. I see you just mentioned book value, but how do you look at book value per share in relation to the price per share of a company? How much margin of safety are you looking for?
Well, a company I was looking at today, its book value is $3 and change. The stock price is about $2. Then you have to look and see if the book value is actually truly representative of what the company is worth. So say if there's a lot of the book value is in goodwill being that the company's overpaid often for other companies, well, that can be a bit of a red herring. But book value, again, company I was looking at today, the book value is 3, the company's trading at 2. That can be, reasonable. It's not outwardly in any way, shape, or form. When you buy something in a store, I'm always a big proponent of buying things on sale.
Mm-hmm.
You can buy things early December and pay 100%, or you can wait a few weeks and get it for half the price.
Yep.
You are buying the same thing for a lot less money. That's a wonderful thing. Book value, if you can buy well below the book value, that can be a wonderful thing too. But again, there's wariness, again, depreciation can be a factor. If you're buying equipment, what's that equipment really worth? There can be an advantage if they have real estate. The increase in the value of the real estate might not be accounted for. So book value unto itself is a factor, but then you want to look further into what that book value actually is. So sometimes what happens, a company takes a major write-down, and what that does knocks the book value way down. So the company you thought you were buying that maybe you paid $3 for, the book value is $5, all of a sudden you've paid $3 and the book value is $2.
Yeah.
But these things aren't easy to know in a lot of ways. If the company has solid assets, like real estate, and the real estate's on the books for a cheaper price, well, real estate generally, not always, is pretty solid. But real estate can also go down quite a bit in value. It doesn't happen very often, and it's not something I think one should worry about all the time, but one has to consider that. But hard assets, a lot better than, thinking assets in many ways.
Mm-hmm. Price to earnings ratio. How important is that to you now?
Yeah, it is definitely important. I don't want to be paying a huge multiple of the earnings, so I don't want to price too high. Then what you generally want to do is forecast out to some degree where the earnings might go. Not easy to do. Because I'm buying companies that are beaten down, I can often look at past earnings and try and forecast if that might happen again. So price to earnings is an important characteristic of a stock. We're looking at qualitative and quantitative things here.
Mm-hmm.
That's more of a quant, obviously, but even quants aren't perfect in any way, shape, or form. So, and then where is it going to go from here? If a company's not making money, well, it doesn't have a price-earnings ratio, so to speak.
Yeah.
So what will happen where the company might go from here to get back where it has earnings and the price earnings? I mean, you could hypothetically talk about a negative price earnings ratio. I don't know that anybody really does that. Certainly we talk about negative earnings, and a lot of companies I buy into have had negative earnings for a lot of years. So when I go back 10 years, I'll see how many years it's been losing money, if it has been. I mean, a company I was just looking at, I think it was 3 or 4 of the past 6 years that had lost money. And certain companies in the cycle in which they operate, they do lose money now and again, sometimes more often than not. But price earnings is important than what you might think of as a more standard price earnings ratio for that company. Mm-hmm. And where will the earnings go? If the price of the company goes the way that it has in the past, where would the price of the stock go again? So history is so important. It's not perfect,
Yep.
stocks in any way, shape, or form. But by understanding the corporate history and understanding economic history and what companies do under certain cycles is very important. And you want to make sure that you do a little digging to do that. And some people, and I completely understand why, they're not willing to do that.
Mm-hmm.
Plain and simple. So they buy into a mutual fund, or they let somebody else manage their money, or they buy into an ETF. I mean, the caution there and what to think about with ETFs and mutual funds is what are the expense ratios. I would say as a general rule, it's better to buy into something that has a lower expense ratio. And you can often have a choice of 2 funds that invest in virtually the same things. And in one, maybe the ratio is 2.5%, and one, maybe it's 1%. Odds are over time, the 1% one is going to do better than the 2.5% one.
Mm-hmm.
And now you've got some where the expense ratios are even, less than that. And that's changed a lot. It used to be, I think, that Canada had the highest fees in the world for mutual funds. Now, I don't know where Canada stands now, but it's very important to find a fund or an ETF with low fees. So that's key. And those fees are out there. Look at the fees closely when you buy in and ask yourself, why would I pay a higher fee when I can possibly pay a lower fee? Then what you might want to do is look at what each of those funds hold and
Mm-hmm.
see if they hold similar or the same things. If they do, well then why would you pay more money?
Yeah.
Because then you're getting, the same product and paying more for it. It doesn't make any real sense.
It doesn't make
Some
sense.
people say, no way, I don't want to do that kind of research. I bet you can do that research in under an hour. Okay, let's say it takes you 3 hours. 3 hours, what's your return going to be on that research? It can be quite something. So you want to make sure those fees are as low as you can get in most circumstances.
Absolutely. And someone like Buffett might tell someone, just buy the S&P 500 index ETF, which has, I think, one of the lowest MER fees in the industry, and the returns speak for themselves.
And I think, and that's a great point,
Mm-hmm.
place to buy into. Now, going ahead, the stock market over the past few years has been a pretty easy place to invest in. And again, looking a bit retrospectively here, we're always doing the research, other people do the research, so that always takes the time. But as they say, as we put on the front of each of our investment letters, past returns are not necessarily indicative of future returns. So what the S&P has done over the past few years, I certainly wouldn't be counting on it. As a matter of fact, I'd be thinking if one should reduce their exposure to markets at this point in time.
Interesting. I think the historical return, if you look back 100 years in the S&P 500, is right around 11%.
Is it that high?
Whereas, I think so. I think it might be between 10.5 and 11%.
And that's over what time?
Over that period. Yeah. So if we're to go to the next one here, Benj, you touched on this, and you brought up that great example of the financial crisis, and that was a perfect opportunity to go cherry picking some of these regional and larger banks like Bank of America. downtrodden industry is in your system. I believe in 2001, 2, and 3, you're also buying into what was a downtrodden industry then, the airline industry, right? You have some examples there, and those 3 years, 1, 2, and 3, 2001, 2, and 3, are some of your best years in the Contra President Fund. I think it was something like 60%, 45%, and like 65%, year after year after year. So
If only that would continue every year.
tell us about that time, like post 9/11.
Well, I mean, in some ways, it was obviously a horrible time.
Mm-hmm.
I think there was an overreaction to a degree, and my simple thought was people are going to fly again.
Mm-hmm.
People are going to want to travel. The world's getting richer. More and more people, especially people who were in what it was called at the time third world countries, they're going to want to travel. So people had to spend a certain amount of time thinking about what had happened and maybe then avoiding travel to a degree. For me, being the contrarian that I am, I thought, wow, I can get some of the best prices ever by traveling now. So, you know, it was a horrible thing, but again, I think there was an overreaction to a degree. There are always catastrophes, and that was a very specific one there. The reaction to the catastrophe, I would say, probably caused far more negative repercussions than the catastrophe itself.
Mm-hmm.
So I think one has to, look ahead, get out that crystal ball and say, okay, here's where we're at now. Here's what has resulted because of what happened. How long might this go on? And how might, I don't mean to sound inhumane, but how might I profit from this? Because by investing after a catastrophe, you're not going to have any real impact on that catastrophe unless it's a very specific circumstance. You're just going to buy into, say, the airline companies or companies affiliated with travel, but you're not doing anything really negative to the system. There's always some people out there, some radicals, there's people who like to hate, there's people who like to destroy, and they have in their minds good reasons for doing it. And they often have this belief system, and often they're backed by their gods when they do it. In some ways that's very chilling. In other ways, this to me is just, hey, what philosophy? This is just the way that things are and always have been.
Mm-hmm.
We've always had people who will work, be it in a religious way or a political way or a way to gain more wealth, and they will do all kinds of things that are very negative to do that. And it's a sad state looking at humanity from that perspective. But this is a major part of humanity. We have a lot of good sides, a lot of good people, we do a lot of good things, and at the same time, there are just horrible things that humans do to each other, to the environment, to other animals, etc. I personally don't perceive that that's going to change. Mm-hmm. I hope it'll change. I think maybe we could put something in the water or in the air that might make us happier and more enlightened and more optimistic.
It's an unfortunate aspect of human nature. As you say, it just doesn't ever change, does it? And for viewers, talking about downtrodden industries, for viewers watching who are on the younger side, they're not going to even fathom that at one point, technology was a downtrodden industry, right? Post, let's say, 2000. Tell us about that time, Ben. It took years for the tech industry to basically, come back to resurrect.
I mean, there had been the tech wreck, and you often hear stories about the guys operating the elevator or the taxi driver, and they're giving stock tips.
Yeah.
Plain and simple. And some people say when that happens, that's a good time to beware. It's a negative indicator. And I mean, there's one person who I'm very close to, and she was very much into tech stocks then. And there's an old childhood friend, and I ran into him. Three of us got together. He knew very little about stocks. He was also a gerontologist. He was making a lot of money. He was throwing it out there. You might say planting seeds. And he was so happy telling me how much money he was making. And he knew very, very little about investing. So a lot of people after the tech wreck, as it's known, they got out of tech stocks altogether. And then as happens, the tech stocks started to come back, and it was a great place to make money. And this is the same thing in many fields. Oil and gas has its time. Commodities has its time. But that was when technology went way out of favor. Technology, is constantly changing and constantly evolving. And there's always articles on the next best thing and the current best thing. And technology is important. But it's very, very difficult to know what's going to be the next best and greatest. You have some really smart people in technology, probably some of the brightest minds in the world, and some of them have made a fortune or making a fortune, but at the same time, technology can turn badly, often fairly quickly. Read these articles on some of the tech companies. And my God, they're just going to keep on going up and up and up, and often they've gone up for a while, but it's never going to stop. I mean, infinity, they're just going to blow through infinity somehow. But you got to remember, the exceptions are the companies that do really well for a long period of time. So one has to think about when is a good time to cash the chips in, when to take some chips off the table. And I'm constantly evolving the portfolio. And as I said, I always have my initial sell target, which grounds me. But after 2000, I mean, things just went crazy in the tech sector. But we've also seen it, in the drug sector, in many other areas over time. And they just get hot, and then they're not. And people often, they follow the leader. Mm-hmm. People are afraid of missing out, FOMO. That fear of missing out is very, very important. And a lot of the people who have that to the highest degree are people who get in late, plain and simple. And people who haven't really thought things through. What they know is, Mr. Smith next door and Ms. Jones on the other side, they're doing really well. And I'm getting 3% on my GIC. So, one has to be aware, and one has to think, where in the cycle am I getting in? And that's not easy to know. Yep. But if prices have been moving for quite a while as they were then, the question was, when is the bubble going to burst? And, we can go back to things like the Tulip crisis.
Yes.
The Tulip Mania. Really, yep. In Holland way back when. And the price of tulips went up stratospherically. All of a sudden, tulips literally were worth the price of a house. Now, I like tulips. Sometimes I'll give my wife tulips. But I have an idea what tulips are worth. And it sounds stupid, right? We're sitting here, how can tulip be worth so much? But people decided that they had this incredible, incredible value. It's funny the way the human mind works. And we also have to remember, we can look back historically and say, this is what happened. this is why what's going on now doesn't make sense. But a lot of people aren't going to get that historical perspective. They're not going to look back to see. And then they'll have somebody who's blowing in their ears and saying, oh, you got to buy this area. You got to buy this company. And maybe they'll hear from the neighbor who's done really well in it.
Mm-hmm.
And a lot of people are prone to, again, FOMO, and that fear of missing out is important. It can often seem like everybody's getting ahead but me, so to speak.
Mm-hmm.
There's some schmuck over there. So, you know, it's interesting. I'll tell you one story way back when. During the day, I was working in the student department for the government, getting students jobs. And then unfortunately, when students got out of school at the end of the school year, I got switched to the filing department. So I had to know three things: my number and color coding, and it was boring as hell. I didn't do it for very long, although it paid pretty well.
Mm-hmm.
One of the guys who I worked with in the evening, I did that during the day, Richard, we were in the dentistry building at U of T. We were cleaning. I was working 4 hours a night. Was it 4 hours? Yeah, from 7 to 11 at the dentistry building. Any idea what was one of the byproducts at the dentistry building? It's not an easy question.
Byproduct. I can't even imagine. I've not even been anywhere close.
Gold.
Oh, yeah, the fillings. Okay.
Gold fillings.
Yeah, back in the day. Okay.
So Richard, he was accumulating gold that way because the price of gold then was near historical highs. And
Is it 70s, Benj?
Hmm?
Is this the 1970s? I can only make a wild guess here. Like
Yeah,
what
that makes
decade?
sense. 50s. Yeah.
Okay.
And I think maybe early 80. He was welding it together to sell it. And he was a go-getter. He was a janitor. He was a smart guy and a go-getter. So I started to collect gold too, but never had anything of any real worth. And it was just a neat time. But gold became worth so much. And there I was, you know, day job, night job, putting money away to go back to university so that I could go get my MBA. But that was a mania back then.
So here's a question for you. This is a perfect question at this time. Bitcoin. Is Bitcoin more like Tulip Mania, or is Bitcoin the next gold in your mind? What side of the fence are you?
Well, Bitcoin doesn't have any practical use that I know of. Do you know of a practical use for Bitcoin? You can make money off it, but...
Yeah.
And I used to get asked a lot on BNN about marijuana stocks and Bitcoin when it was in its infancy. You know, it's the value that people place on things.
Yeah.
Does Bitcoin have any, I'll say, real value? I think it's highly questionable. On the one hand, I'm in the warning Charlie camp on that. But does it have real value? I may sound like I'm contradicting myself. Of course, because people place this incredible value on it. I suppose you can cash it in and buy other things with it. Does that make some sense? But on its own, you certainly can't eat it. You can't. I mean, I could say, name something, give it a new name, and somehow advertise, and enough people might fall behind it and say, yeah, it has value. Bitcoin, I don't know, stained glass, whatever. But it does have it, and a lot of people are making a lot of money on it. My son Caleb, he's involved with Bitcoin. He's making money on it. I'm breaking perfectly even on Bitcoin because I haven't invested. I don't, well, do I understand it well enough? I used to talk about Bitcoin a lot on CBC. I understand it. It's difficult to really value. And I like seeing some sort of utilization. And I don't really see how it's being utilized. So it's a wonderful thing to market to the masses, and to some degree at certain points in time it will be part of the greater fool theory. You own it, you try and sell to somebody at a higher price, but at the same time you're just going to have, and you already do, Bitcoin millionaires. I imagine there's Bitcoin billionaires. I don't think I'll ever get involved in it, but it's a fascinating study. And of course, when it goes way down, the naysayers will say, I told you so. And as it goes way up, the yay-sayers will say, yeah, I told you so.
It's the ultimate test of fear of missing out currently, isn't
Yeah.
it? Bitcoin.
And it's fun for me to watch.
Yeah.
It's also fun to think how quickly it became an important part of the economic system. And it became a way of valuing part of the economic system, because it became something very, very quickly after it was invented. And a lot of things simply do not do that. It's a real exception to the rule.
So here's a fun one, Benj. This is the next point.
They're
on the
all
point
fun
tally
ones,
system.
Robin. They're all fun.
Readable annual report. What do you mean by that? Are some annual reports just like you think, who the hell wrote this thing? Who signed off on it?
Yeah, some annual reports are far better than others.
Yeah.
Some of them are primarily marketing tools
Yep.
for the company,
Mm-hmm.
and one has to be wary of that. Some of them are full of jargon. I'm not a big jargon fan. Some people think they sound really smart with jargon, or whatever. But having an annual report that has some detail and is readable and is understandable is important. As I said, I'll contact a company and see about getting the past 3 or 4 annual reports. I'll look at them online too. There can be a tremendous amount of information in them. I know Phil, who I mentioned before, who works with us, he goes into them in, I think, a lot more detail than I do, to his credit. But having that information and tapping into information before you make investments is key. And again, I'm reiterating, that's why I don't buy into a company before I followed it for quite a period of time. But annual reports are a key way for companies to get their information out there. But again, one has to try and understand, is the company putting out that information so that people will be more informed, or so that we market to those people, or is it some sort of combo of the two? So, I mean, you can see, I have the filing cabinets behind me there.
I see the two. Yeah.
Some of them are full of annual reports.
Mm.
And then before I buy into a company, I will go and pick out that company, lie on the couch often, or sit on the couch and read through and go back a number of years, besides doing it online.
Mm-hmm.
Doing it online, as we alluded to before, I don't get the same perspective as when I'm just there and, and chomping down on it. It's a good place to chomp.
Completely focused, right? You have no other browser tabs open. It's just you and the annual report. The next point here, Benj, is something that I think a value investor can struggle with, especially a contrarian like yourself. It's public awareness. And this is the next point. So let's say you have a thesis for a company and you're sure it will turn around, but if there's no public awareness, if there's no eyeballs on it, if there's no other investors like you who see the same catalysts, you could wait years and years, and in some cases, the price doesn't revert to the past historical price or go to your price target you have in mind. So can you tell us about that?
Well, price awareness also has an ebb and a flow for certain companies.
Mm-hmm.
Sometimes a company is very much in the public headlights,
Mm-hmm.
and that often can be when they're doing really well or when they're doing really poorly.
Mm-hmm.
And then sometimes it just fades. Some companies will spend a tremendous amount of money trying to get in the public headlights, trying to get the marketing going. So often I'm buying into companies that once were much better known and no longer are. People no longer give, as my grade 5 teacher would say, give a tinker's damn about it. He liked that expression. I can't believe I came up with it. And so that's important. But, just because a company is out of favor and largely forgotten doesn't mean that it won't come back into favor later on.
Mm-hmm.
Some companies that I buy into, they have to trade a certain volume of stock before I can buy into them. Otherwise, I can't make what for me is a significant investment. And then I also had to look at people who were subscribers for Contra the Herd. There had to be enough there trading that they could buy into those companies. So what it's trading at now in terms of price, what it's trading at now in terms of volume will not be static. But there's certain companies I will simply reject and say, it doesn't trade enough, it's never traded enough.
Yeah.
It may look like it has potential, but if it trades 1,000 shares a day, I can't get a position, really. And that's changed over time because I invest more now, thankfully, than I invested when I started because I was investing next to nothing.
Mm-hmm.
So awareness can be key, and also if a corporation that falls out of the headlights can regain awareness.
Yeah.
If it's out of the public eye, will it come back into the public eye?
Mm-hmm.
When will it come back into the public eye? Maybe when it's going bankrupt. But the other is when it starts to do well.
Yeah.
And when it starts to do well, it can really start leapfrogging in terms of price. And often the people who get in later on are the institutions.
Mm-hmm.
And the institutions generally have a lot of money. And I love it when I buy a stock at $1 a share.
Yeah.
And the institutions are then paying, $5 and $8 and $10 a share and putting their money behind it. And I think at that point, they're actually being very smart for me. And they are putting out the word, to their subscribers or their followers that we think this is a great company. And I think mostly they do believe that. But they certainly would have missed, the boat to a large degree. Mm-hmm. But when they finally hop onto the boat and start rowing, that's in my best interests.
Exactly. Just extra premium for you, right? The returns
so
continue
awareness comes to people and organizations at different times.
Yeah.
So I'm hoping to have a real awareness at a company when it's out of favor and when it's cheap and when it has what I perceive to be a tremendous amount of potential. Now, I'll add a little something on. I almost always sell corporations too early.
Mm-hmm.
So, again, maybe I'll buy at 2, I'll sell at 8. There's a good chance it'll go up to 16. Do I wish I had held to 15, 16? Absolutely.
Mm-hmm.
And I'm often selling on the way up, but now I'll only sell twice. I'll sell once and then sell again. To target the company at the actual height of the stock price is very, very difficult to do. I've had a couple instances, I think, where I've sold at the top penny. But I'm talking a couple instances in 30 years of investing.
Mm-hmm.
If I can sell near the top, I'm happy. If I just sell it at my initial sell target, which again is going to be normally 100% plus gain, I'm happy. Somebody I work with, the stock price keeps going, and he's giving himself the paddle because he feels he was stupid. Yeah. I don't think that's the case. I think it's part of the game.
Yep. The next couple here, Benj, are self-explanatory. Obviously, excellent cash flow. you give a point for your understanding of the business. So when it's on the watch list, it's on the watch list for at least 6 months, and you understand the business intimately before you invest in it. Possibility of a takeover is also a point.
Mhm.
But the very last point here, and I know you prefer valuing companies based on tangibles, but you also will give a point based on intangibles. So what are examples of intangibles that you would you value a company on?
Well, I think my business partner, Ben Stottleman, is great at this.
Yeah.
You get a feel for a company. And after
Hmm.
30 years of investing, you get a certain spidey sense of what's going on. And sometimes they'll say, okay, the company's, in terms of the point tally system, it's on the cusp. But my feeling is that this company is going to do better and the stock price is going to go up. And it's like people in, I'd say, virtually every field.
Hmm.
People who've worked in the field for a longer period of time, all
Hmm.
things being equal, are going to have a better idea of certain things that can be quite small, quite minute, that will make a better product. And a lot of other people wouldn't even see that possibility. So, it's sometimes I look back and I think, oh my God, how could I have been doing this for so long? I mean, I started investing when I was a teenager, so it's over 40 years ago, 45 years ago. And again, as I said before, you learn a lot from your mistakes and you learn from what you do right. And you learn from what's very concrete and quantitative. And you get a better idea of the qualitative aspects. And sometimes I'll just think, oh man, this company just makes sense to me. And there still has to be the backing in terms of the numbers. And then there's sometimes where the contraire can happen. And, the numbers are there, but there's just something holding me back.
Hmm.
And again, as I alluded to before, there's always other companies to buy into.
Yeah.
Always. And over time, there's always other companies. Now, for people who are looking to buy a lot of companies, that's one thing. But for me, if I'm looking to buy my, 4 companies or so in a year, I don't need a lot.
Yeah.
I just need a few. I need to select a few really beautiful cherries. And that's all I want. All of the other stuff ultimately becomes an aside. But if I can do that, there's a good possibility that over time I'll have excellent returns.
It's not on the system itself, Benj, but I've heard you say it before. You will not invest in a company on the TSX Venture Exchange. That's just because of the longevity of the company? It doesn't meet your requirement, basically, of a dividend-paying company, and you're not able to go back 10 years.
It's much more of the Wild West show. You don't have a very good idea what
Yeah.
you're buying into.
Hmm.
I do own a couple there now, but they're companies owned by my friends. Excuse me. And for that reason, I got into them hoping that I would get a good return and also to support my friends. And I can say right now, the 2 that I'm in, if I had my druthers, I never would have bought in. Sure, it feels good to some degree, but they've cost me quite a bit of money. But again, going back to that 1 to 4 weighting system,
Hmm.
4 being I'll invest that much more. In these cases, I didn't even invest a 1 because they weren't my kind of companies at all.
Yeah.
So yes, I've lost money. Then the question becomes, okay, when to take the tax loss? It's one thing to take a tax loss in a company on, a major company or a company on the TSX, whatever. But do I take a tax loss in the company that's owned largely by my friend? I'm sure he would understand. He's lost money on it too, to a degree, although he also got a lot of shares at a much lower price. Or do I hang in and hope that things would turn around? And I was just at the AGM for one of the companies,
Hmm.
and I knew a bunch of the other people there because some of them are mutual friends or acquaintances, and some of them I don't mean this to sound like ego, but they were looking up to me because they know I'm in the stock market and what I do and the returns. But, and it's interesting because my business associate Ben got into one. And he showed up at the AGM. And he didn't tell me he was coming. And when he came and he sat down next to me, I said, "What are you doing here?" He said, "Well, I wouldn't have missed that." And you get far more insight. And this is a good thing to do. Go to companies' AGMs. Their annual general meetings can give you tremendous food for thought. And you get to hopefully shake hands with the decision makers. You get a better idea about the companies. There may just be a few salient points that you hadn't considered. And that can be time, very, very well spent. But, I avoid companies on those exchanges, generally like they have leprosy. But again, a friendship to me is exceedingly important. I was talking about this with somebody the other day. I have friends going back to when I was 6, 7, 8 years old. I was talking to one yesterday.
Yeah.
And there's a real value in long-term friendships. You get together, you can often talk the same language in many ways, you share a lot of the same memories. But when I saw Ben at the meeting, well, this is interesting that you're here. And I saw other people who came up to me and, "So what do you think now?" And part of me thought, I think management is good in a lot of ways, but they're so far behind the 8 ball in terms of building a company. It's very, very difficult. And am I hopeful that in a year's time I'll go and the stock price will be double? Sure, I'm hopeful. Do I think that'll happen? Well, it's a lot easier for a company to double from 5 cents to 10 cents and from 75 cents to $1.50. But I'm hanging in. I watch them, and I hope. But as I said, my investments in them were relatively small.
And supporting a friend, which is what matters, right?
Well, it's important, and again, hopefully get a decent return.
Speaking of Ben, your co-founder and business partner, you recently made the decision to consolidate, to combine the president's portfolio and the vice president's portfolio. Whereas before, it was a little bit of friendly competition between the two of you. Tell us about why you made that decision and how the dynamic has changed and evolved.
Well, Ben might have thought of it as a friendly competition. I never really thought of it as a competition. But if you look at the numbers, the primary reason was that Phil was going to take over and manage the portfolio.
Mm-hmm.
So he was working with Ben on the vice president's portfolio.
Yep.
So they decided that was the one that they were going to keep on going. Now, there was a certain overlap of stocks, and there still is.
Yep.
But that was a decision that, this is what Phil was doing. So they've kept that one going. I'm curious because we're going to have the 2024 results in shortly.
Yeah.
And Phil he's a smart guy. He's a good operator. Mm-hmm. But that was the primary reason to do it. And it's been great for me in a lot of ways because it gives me a lot more free time. I still do all the research on the stocks, but I don't have to write up the release. I don't have to deal with as many subscribers, although I deal with some who contact me. And at Contra the Herd, we're happy when people contact us. Anybody who wants to contact me, go to GALL@pathcom, PATHCOM.com. Send me a question. Even better, send me some answers. But that was the primary reason, so that Phil could manage the portfolio. So I'm still involved, but I've taken a step back.
Mm-hmm.
Ben is still involved, but he's taken a step back. So Phil is managing it, and I give my input, and he chooses to accept what he wants, and he chooses to ignore what he wants. And hey, I'm used to that kind of thing in life.
Absolutely. Benj, when there were the two separate portfolios, yours being the president, Ben's being the vice president, what would you say the key differences were in selecting equities between you and Ben?
Um, that's an excellent question because the results were, his results were very good. My results were that much better. Um, I think more so when Phil came on, they would buy younger companies, not around for 10 years. That was a factor. I think, even 10 years, it's a reasonable amount of time, but sometimes maybe he would get unlucky with some of the companies. Maybe I would get lucky. Uh, yeah, he would select in a somewhat different way, I would think. It's probably fair to say that I would look around for more advice from people that
Mm,
Ben is a bit more of an independent operator, and I can understand that and I can respect it. Um, I want more ideas from other people before I make a decision. So there were things like that, but I mean we had a number of stocks in common and a number of stocks that were different. It's interesting for me now to watch what Phil buys, and
yeah.
he's much more active than I was or I am.
Hmm.
As I said, I've only bought one stock,
Yeah.
but again, that's an aberration.
Yeah.
And he's bought a number of stocks, and I think he's bought a number of good stocks. But I don't know if one could say I cherry pick more. I don't know. I just don't really like where the markets are at now, and I own a lot of companies already, so I'm under no major compulsion to buy more.
Yeah.
But Ben and I, we met at Western University. No, we didn't. We met at the University of Western Ontario back
Mm,
in the day, and we were, as Ben might say, being a farm boy, knee high to a grasshopper. Um, and we've learned a lot from each other over time. And he's a fabulous investor. And he's super smart. He's so much smarter than me in so many ways and about so many different things. And I wish I had some of the smarts that he has in many other ways. Uh, and Phil has a lot of smarts too. And
yeah.
yeah, it's fascinating to think how things have evolved since we started it and what we've learned and where we're at now. I mean, we are certainly closer to the end than the beginning. Um, but I'm hoping I'll be investing for a number of years still, and be investing in my dotage. I don't think I've reached my dotage yet. Other people might disagree, but hopefully investing into my dotage for another 15, 20 years. And even if I'm not quite as sharp, hopefully I can still have very good returns.
And I'm hoping to see you again on BNN Market Call. What happened there, Benj? I grew up, watching you throughout university. That was one of the highlights, right, on Market Call, seeing you on there.
Well, I appreciate that. That was completely their decision, and I was told by Andrew Bell, it's not anything we did. They changed who they were looking at, and I never completely understood it. I had to accept it. A BNN was our primary way of getting subscribers, so we loved being there. I loved being on. I loved being on TV. It was fun. It was
Hmm.
fun when I would be at a restaurant and somebody would come up and go, "You're Benj Gallander." Yes, I am on a good day. Um, so, I mean, I really enjoyed it. If they asked me today to come back and be on tomorrow, I would jump at the chance. There's no question about
Let's try to make it happen. Let's try to make it happen, Benj.
Let's try.
I'm gonna tag BNN Market Call Andrew Bell on this video.
Well,
I want to
I
see
would
it.
love to get back on. I know a lot of
Yeah.
people asked me where I was. I would get emails, and they
Yeah.
said they were writing BNN. I remember at one point going way back, the Globe cut us.
Hmm.
All of a sudden they said, no, we don't want the Contra guys column anymore. And we had no choice. So for about 2 years, we didn't have a column with the Globe, and I loved it. I remember being a little gaffer, and I'd be on my hands and knees reading the sports section on the floor. The Globe was the paper we got in the morning, the Toronto Star in the evening. But they just decided, yeah, we don't want you anymore. And again, about 2 years later, they changed their mind. I don't know the actual reason why they cut us. A lot of people also thought it was really stupid. I'm not completely clear on why they brought us back, and we still write it today. And I love seeing it. It gives me a kick when it's in the paper, which reminds me I better write the next column tomorrow. But people have a certain authority, a certain power, and they're in a position that we can say, no, it's a bad decision, don't do it. But they have that power. And then again, with the Globe, they said, we're not really sure why we cut you, people. We want you back. Great. So we were back. Logic. Logic is not stable. Logic is not
Hmm.
necessarily a straight line. Decisions made today do not necessarily make sense tomorrow. They might not even make sense today. But sometimes, we are on the outside of it and we simply feel the repercussions of it. And that's part of the nature of life. And, the old expression, let me know what I can change and what I can't. And my grandmother had a rendition of that in her mirror at home. So that's important to understand. If you understand what you can't change, that can make life easier in a lot of ways. If you think you can change it, well, see what you can do. And hopefully, I've got people, as you said, you on my side, maybe you convince the BNN to throw us back on, or maybe another TV station. I haven't pursued that, but maybe if we got on somewhere else, that would be very, very cool.
Very cool for 2025. Is there another book in the works, Benj? Within the next 5 years, are you planning?
I'm waiting for you to write another. Are you writing another?
I don't have any plans right now. I'm not writing. I'm just focused on this podcast. But that would be an interesting project to take on. It just takes so much work and
You're
so much
focusing
time out
on
of my day with the 7.5-month-year-old.
That's what I was going to
See
say.
if we
You're
can make it
focusing on the
happen.
podcast and the baby.
Yeah. Yeah.
I don't have one in the works. Every once in a while, I think maybe I should do it. And then I think about the amount of work that it takes.
Yes.
And it doesn't really attract me. As you may know, I had 5 plays on over the years. Would I want to write another play? It's first of all, it's one thing to write it, which takes a lot.
Mm-hmm.
But then to actually get it on is another thing.
Mm-hmm.
If I wrote another book, would a publisher be there with waiting arms? I mean, before I wrote the last one, Penguin had recruited me. And having Penguin recruit me was great.
Yeah.
I wouldn't want to race and look for somebody now. I guess I could. But again, I think part of it is an aging process. I don't necessarily have the motivation that I used to have. But if a company came to me and said, we really want you to write a book. We want to give you this big fat advance. I might be persuaded. And it wouldn't just be, the money doesn't motivate me the way that it used to. But I remember when I got my first advance for a book, it was a Canadian Small Business Survival Guide. We're going back.
Mm-hmm.
Tony Hawk at Hounslow Press, we met up and he said, I'm going to give you $2,000 as an advance to write this book. And my reaction? Cha-ching! Cha-ching! It was huge for me. It was huge, and that became a bestseller. If people go to our website, I still have some of the later editions here to sell. But again, I don't have the same motivation now. It could change. If I could think of sounds lazy. I remember once reading the book, The Lazy Man's Ways to Riches. And I think they sold a lot of copies, and a lot of them were never read. I think I read mine all the way through.
That's good. Yeah.
But I could think of some simplistic ways to write a book that would have a lot of material that I think would interest people and help them.
Mm-hmm.
I often like books with a lot of quotes. So I think quotes can say a lot of things. Some of my books, at the beginning of each chapter, there's a quote.
Mm-hmm.
And I think that has a lot of value. But if I got approached, as I said, Penguin approached me. It was out of the blue. I said, let's get together. And sure, they gave me a nice advance, and great. Tony Hawk, he approached me. He gave me a small advance, but that became the first book. And, a good part of my career is based on the fact that we did that. So I don't know about another. Hopefully we'll be writing the Globe articles for a number of additional years. I still write for Canadian Money Saver a few times a year. I write for some places in the States, some magazines a few times a year. But nothing major in the works, and I'm quite content with that.
Yep. So to close out, Benj, can we get your thoughts on the top 3 highest conviction positions in the portfolio for the year 2025?
Okay, well, 3 positions that I'm hot on. Let's see if I've got something here.
Sure.
Okay. I actually know them offhand. So one, in some ways, I sound like a fool saying it, but I really like BlackBerry. And I've been saying BlackBerry for years, and we've actually made a lot of money on BlackBerry. BlackBerry's had some pretty interesting gyrations in terms of the stock price. So overall, people look at it as a kind of dumb position, but I like it. I think it has a lot of potential. I think they're moving in the right direction. Another one is Banco Bradesco. I don't know if I'm saying it quite right. Banco Bradesco. It's a Brazilian bank. It's had the crap beat out of it. It used to be a $13 stock. You can buy it now for under $2. I picked it up in December at $2.03.
Mm-hmm.
So, of course, part of that's based on the Brazilian economy, and it's based on the countries nearby. They've got a pretty good balance sheet. Big bank, an important bank in Brazil. The Brazilian economy, it's a funny place to be, but it gives me geographical diversification.
Yep.
And yes, it's a new buy. It's at 203, and it's down a little bit right now. And I'll give people a stock that's not in my normal picking field. I bought Laurentian Bank. Now, part of the reason I bought that, and usually everything I buy is under $10, but it had been hit. I didn't think, and I still don't think, Laurentian will go bankrupt. I think it can double from the level that it's at now, and it was double for quite a while. So for people looking at what they might refer to as a safer stock, it is a big Canadian bank, especially in the province of Quebec. I think it could do very well and could turn. It pays a dividend. One might wonder if it's too high, but it is around 7%. So it's giving an excellent return. I don't think they'll slash the dividend from here, but I could be wrong. Almost always make money, plain and simple. And for the Laurentian Bank to, if you think of worst case scenarios, to get into real financial problem and go bankrupt, well, that would be a huge black eye on the province of Quebec. And that would be a huge hurt to the economy in Quebec. As you know, I spend a certain amount of the year in Quebec. We have a place there. And the province is different than Ontario, and I love it there.
Yeah.
and a different joie de vivre, so to speak. But Laurentian Bank is important there, and it is a big bank, and I suspect that it will turn around and come back.
And speaking of BlackBerry, what a storied Canadian company. It was the turnaround under John Chen that just never really materialized, right? It was a 10-year effort. What went wrong in that very bold turnaround ambition?
Well, part of the problem is they paid him too damn much money.
Going back to one of the points, yeah.
It was his compensation. Excessive does not describe it. It was friggin' ridiculous. Now, how much was he a fly-in CEO too? I don't really know. He had a track record, but he didn't have a particularly long track record in terms of
Hmm.
turnarounds. So I think I might have overrated him too.
Yeah.
But he didn't do the job that he was paid to do.
No.
Now he can buy pretty much whatever he wants. I mean, it was stupid. Did you see the BlackBerry movie?
No, I haven't seen it yet. It's on my list.
Yeah,
Yeah.
it's worth seeing. I mean, it's a
Yeah.
good, real Canadian story.
Yeah.
It's very well done. It's a good one for the small screen. I did see it on the big screen. But I guess in some ways, John Chen was overhyped. I mean, my company I mentioned before, Sadisco, the
Hmm.
CEO that went in there, and I alluded to this, he went in, had a good track record, and we got our heads blown off on that one. But you see, buying into a company like a BlackBerry at a certain point in time, it has a name. If it recovers, it has a better chance to go a long way if it recovers. And as I said, I've played that a few times. I'm in there now. I think it's a good buy now. I think it could double from where it's at now. Um, and it's one of those, if it gets some momentum and some good results, it could do very, very well.
It's still a household name. It's true.
It's
Everyone in Canada knows what BlackBerry is.
absolutely. Some people
Yeah.
might still use them.
You never know, right? Ben, this has been a lot of fun. Thanks for the conversation. This is the longest episode yet, and I wish you a very successful, prosperous, healthy 2025. Thank you.
And to you too, Rob. And I always really enjoy it and happy to do it in the future. And wish you and your growing family all of the best.
Thank you, Ben. And we'll see you on BNN this year too.
Oh, I hope so. Thank you so
Talk
much
soon.
for doing this.